In our experience, the biggest problem with the Safe Harbour regime is delayed response and delayed engagement from the directors themselves. The Safe Harbour protections aren't there to rescue a failing business. They're there to help a responsible director identify that his company is in trouble and ensure that steps are taken to facilitate a recovery of financial circumstances, or if that's not the case, a orderly winding up. Hi everyone, I'm here today to talk to you about something that is incredibly powerful, underutilised and very often misunderstood. That's the Safe Harbour provisions under the Corporations Act. Now, as advisors and accounting professionals, you are usually the ones who first see the warning signs. Warning signs may include deteriorating working capital, increases in director loans, increasing ATO debts, which are very, very high point in our current climate, extended creditor delays. The legal overlay sitting behind that is the insolvent trading provisions in the Corporations Act. As many of you are aware, directors have a duty under the Corporations Act to prevent the company trading insolvent. Now, if the company does trade insolvent, or the director suspects the company is trading insolvent, they may become personally liable. Now, a company may be considered as trading insolvent if it incurs a debt, it is insolvent or likely to become insolvent as at the time of incurring that debt. There are reasonable grounds for suspecting that the company is insolvent, and the director or a reasonable person in the director's position would suspect that the company is insolvent. Now, this wouldn't be a large concern in the general course of ordinary trade. However, when we come to circumstances where a company needs to appoint a liquidator, the director can become personally liable for any debts incurred during that insolvent trading period. Now, what does that mean for you? As an advisor or accounting professional, once cash flow issues arise and the director continues to trade without a plan of attack in motion or acknowledge the fact that there are issues in the company, they become personally exposed to any liabilities that are incurred. Now, how does Safe Harbour come into this? Safe Harbour comes into this by providing a potential defence that directors can rely on in such circumstances, given that they abide to a few limitations that the Act does provide. In simple terms, a director may not be considered liable for insolvent trading if they are developing a course of action which is reasonably likely to ensure a better outcome for the company than immediate administration or winding up. Now, what does that mean? The first point to consider is what is reasonably likely. The threshold for this is lower than more likely than not. What this requires is an objectively supportive basis. It's not mere fanciful determination, it's not hope, it's some sort of certainty that the director is able to base his decisions on. The next point to consider is what is a better outcome. Now, the better outcome is determined at the date where the director suspects that the company may be insolvent. A better outcome basically just means that the plan will ensure a better future for the company than an immediate winding up. Now, this test, it's a counterfactual test. So what would be considered is if I wound up the company right now and appointed a voluntary administrator or a liquidator, would my creditors be better off? Or if I implemented this plan that I'm considering, will then my company, one, continue trading, two, any creditors, would they be better off? Now, it's good to know that these provisions are available to directors. However, it must be noted that they are not automatic. Some prerequisites that are required in order to even access these provisions is one, employee entitlements need to be paid on time, including superannuation, and two, tax lodgements need to be made on time with the relevant tax authority. If the company does have superannuation outstanding or any tax lodgements that are outstanding, the Safe Harbour provisions won't apply. Further, these protections only apply to debts that are incurred in the ordinary course of business, so general trading of the company during the lifetime of the plan, which can include the payment for a restructuring advisor. Unfortunately, what the Safe Harbour does not provide is a blanket immunity for all trading. Course of action. What does this look like? Now, the first and often the most important step that a director can take is to appoint a qualified advisor to help them consider, construct and implement a Safe Harbour plan. The Act provides a list of non-exhaustive factors courts may consider in assessing whether a director has taken a course of action. Now, these factors include whether a director has properly informed themselves of the company's financial position. That means not being blind to financial statements, not being blind to what's inputted into the management accounts, but taking an active role in the company's financial circumstances. The next point is whether steps were taken to prevent misconduct. Misconduct would include any actions that lead to misconduct in the company incurring a debt. Whether appropriate advice was obtained, again, going up to that first point, you need a qualified financial advisor to advise you. We at O'Brien Palmer do see quite a few of these engagements, and it is very important to note that these engagements are confidential between you and your advisor. It is not something that is public record. Whether a restructuring plan was developed or implemented. Now, in developing and implementing your restructuring plan, it needs to be documented. It needs to be in your board meetings. It needs to be in your minutes. It needs to be something that is taken out daily, reviewed and analysed. And finally, whether books and records were properly maintained. Again, there is no plan without a record, and there are no records if your company is not maintaining documents correctly. To recap, what this means from an evidentiary standpoint is that you will need to maintain reliable management accounts and cash flow forecasts. What often is utilised is a 13-week rolling cash flow. It is useful to conduct a sensitivity analysis on your cash flow, see what may or may not occur that will affect your future cash flow. It's good to look at budgetary requirements and where further finances may be obtained if needed. And of course, you need board minutes that document and record your deliberations regarding the Safe Harbour plan and its progress. It is very important to remember that a poorly documented plan or plan that is not documented at all will not satisfy the Safe Harbour provisions. Now, what you may be thinking is that these protections sound great. However, what we should note is they don't protect against all liabilities. It is a defence to insolvent trading. What that means is director duty breaches are not within the scope. Any liability arising from voidable transaction claims will not be within the scope, and any Phoenix activity enforcement will not fall within the scope. If you're not sure what Phoenix activity means, in very general terms, it is circumstance where one company stops trading, another company starts trading, same directors, and the debts are forgotten in the last company with no consideration given. In saying this, there is illegal Phoenix activity and not illegal Phoenix activity, so make sure you always talk to your financial advisor if this is something that you are looking at doing. Another important thing to note is Safe Harbour protections don't extend for forever. They do end. Circumstances where they can end include if the directors fail to develop and take a course of action within a reasonable period. Now, what does a reasonable period means? It often is dependent on the complexity of the company itself and the complexity of the financial circumstances. When the directors cease taking the course of action, when the course of action ceases to be reasonably likely and lead to a better outcome for the company. Think back to what that means. Reasonably likely is, again, better than not. And better outcome means a better outcome now than an immediate winding up. And of course, protections will end when an administrator or liquidator is appointed. The Safe Harbour regime first was initiated in 2017, and the aim of the legislation is to assist directors in understanding insolvency. Again, directors should remember that the engagement of a Safe Harbour advisor is a professional engagement. It's a private engagement. It's like engaging a solicitor or accountant to do your everyday, ordinary business processes. There is no statutory trigger that requires for this appointment to be disclosed. In our experience, the biggest problem with the Safe Harbour regime is delayed response and delayed engagement from the directors themselves. The Safe Harbour protections aren't there to rescue a failing business. They're there to help a responsible director identify that his company is in trouble and ensure that steps are taken to facilitate a recovery of financial circumstances, or if that's not the case, a orderly winding up. The practical reality that we see every day is that the availability and, of course, defensibility of the Safe Harbour plan is tied in very closely to timing. What we often see, and again, it's unfortunate to note, is that by the time people come to us, it's just too late. There is no option but a formal insolvency appointment. So the more you know about these protections and the more you know that there are actions that you can take as a director to ensure that, one, you're protected, and two, you understand financial risks and the circumstances of your company, and understand that there are options available to you, being, one, engage your Safe Harbour advisor and see whether a plan can be viably implemented, or if that isn't available, then engage a small business restructuring practitioner, voluntary administrator, or liquidator to ensure that if the company is trading insolvent, or there is a risk that it may be trading insolvent, that comes to an end, and consequently your personal liability in those circumstances also comes to an end. Although I would love to give you some stories and some examples of engagements that we have undertaken, it is confidential. However, it is something that we at O'Brien Palmer do handle regularly, and we do get good outcomes for our clients. So if you or your clients needed a confidential discussion, please reach out. My name's Karina. I am a supervisor at O'Brien Palmer, and either I or my team would be very happy to help. Sorry, I lost my point. I won't read it. I'll just have it there in case I need a note.
Yeah.
Brilliant. Love the chopping. Love that you can do that.
Yeah.
Alrighty. It is very important that I've lost my thought. This is really hard. This is so hard. Like, I completely understand.
It's hard because you're trying to be perfect off the ship.
I am. Okay. Okay, sorry. I'm not going to make this too painful. I'll just stop and start without talking to you. I'm not reading it. I promise you. I'll make it into my own words. Okay, I'm so sorry about the chopping and cutting. Oh, it's the final one. We are on a home run, and then we can do whatever you want.
You give me the best bloopers.
Please don't do that to me. Oh, God.